Hello everyone, and welcome to Legal Pay Raise Empower Tools. My name is Dr. Trace Bueller, and I've designed these Empower Tools to ensure the success of your home-based business. So please review them as often as necessary so that they become second nature to you. We're very excited to have you aboard. My name is Dr. Trace Bueller, and I helped design these strategies and techniques to reduce your tax and to save you potentially thousands of dollars each and every year with this system. Right now in America, there's an extreme economic difficulties and hardships. And many families come to us asking how they can increase their monthly cash flow. So you may be in the same situation where you're wondering exactly how does this work, where you can just make a few adjustments to some tax forms and automatically each and every month I'm entitled to $100 to $500 a month from my current job. How does that work? Well, let's get right into it. Here you are working your job and you've got some income from a job, and what we're going to do is basically just increase that income. And the way that we do that is by taking a step backwards and looking at why it is that the income coming in from your job is so much less than you're entitled to. For the most part, it is because of income taxes. Income taxes come out of your paycheck, obviously, before you receive that paycheck. So what we're going to do is attack the income tax so that you have less income tax liability due, and so less is withheld from your job. The reason that you are in this predicament, the problem with the situation in America today is that we are not just facing one or two types of income taxes, but we've actually got three different types of income taxes. We've got federal income tax up to 35% if you're in the highest federal tax bracket. And then, of course, you've got state income taxes as well, anywhere from 0% if you're lucky enough to live in Nevada, Wyoming, South Dakota, Washington, Florida. Those states actually have zero income tax, whereas the rest of us live in high income tax states. California is up to 11%. Back east in Massachusetts, other states are usually around 7 or 8%, but that's on top of your federal income tax. Then, last but not least, certainly, is your FICA tax, your Social Security, your Medicare, your Medicaid. That is actually 15.3% of your first $100,000. That's the easiest way to remember it. Just remember your first $100,000 of earned income is going to be subjected to 15%. So just keep the numbers round in your mind. Make it easier to remember. 15% of your first $100,000 of earned income is subject to Social Security, Medicare, Medicaid taxes. Supposedly, we're supposed to be getting benefits from that. That remains to be seen. That may seem high to you. It certainly is. If you add up all three taxes, you're looking at over 50% of your income potentially going to the tax man. What is confusing about FICA and Social Security, Medicare, Medicaid tax is that your employer actually pays half of that for you, but you still pay the other half, and that's what's withheld out of your pay. So if you add all that up, that is an awful lot of tax. So what are we going to do about it? How can we legally reduce that income tax so that you can have less withheld from your paycheck? Well, let's look at this quote from the U.S. Supreme Court, and I apologize for all of the text on the screen, but this is one long quote from a case that was written up by Judge Lernenhand of the Supreme Court. And he made a ruling that is now federal law, stating anyone may arrange his affairs so that his taxes shall be as low as possible. No one is bound to choose that pattern which best pays the Treasury. There's not even a patriotic duty to pay more taxes. Over and over again, the courts have said that there's nothing sinister in so arranging one's affairs as to keep taxes as low as possible. Everyone does it, rich and poor alike, and all do right, for nobody owes any public duty to pay more tax than the law demands. And once again, that's from the United States Supreme Court. You'll see that in other cases. You'll see that written up by people that are commenting on the tax law, but that is actually law itself. Now, it shouldn't surprise you that there are two tax systems in this country. They may look a lot alike, but they are very, very different. It's much like approaching the Manhattan Island. Manhattan Island is surrounded by two rivers. One is actually a tidal estuary and will lead you right back out into the Atlantic Ocean. The other river, the Hudson River, on the west, will take you into the Promised Land, as was discovered by the Dutch West Indies Corporation back in the 15th century when they came into this country and started hunting for beavers and such. And there's a lot of history with the Hudson River. Down the river a ways, if you're not familiar with this area, is West Point, where our founding fathers drug a chain, floating it on logs to stop the British ships from invading our country. And like I said, on the east is not a river at all, it's a tidal estuary, but ironically it is named the East River. And though it may look like you're getting into the Promised Land, you're not. It's going right back out to the Atlantic Ocean. And I say this because it seems very similar, but just like the Dutch West Indies Corporation, Henry Hudson, a famous explorer and employee of the Dutch West Indies Corporation, was one of the first to find this river and to go down it under the guise of his corporation. So that's definitely a clue in where I'm going today, because what we have in this country is two tax systems, one for individuals and one for businesses. That probably doesn't surprise many of you. You see businesses get all kinds of perks in the law when it comes to getting credit, getting finances, having all kinds of resources. Businesses remain supreme. What most people do not realize is how easy it is to become a business. And what's the difference between being a business owner and an individual when it comes to paying taxes? Well, an individual makes money, pays taxes on that money that's earned, and then gets to spend what's left over. Whereas in a business, whether that be an LLC, a corporation, an S-corp, the business makes money, spends money, and is taxed on what's left over. Much different than the individual who makes money, pays taxes, and spends what's left over. What we are here to do is to show you how you can take advantage of both of these two tax systems and get yourself on the correct side of the ledger by having a home-based business and reducing your taxes accordingly. We're wanting you to put the law on your side and start a business so that you can make money and spend money and then be taxed on what is left. How that works is codified in Internal Revenue Code Section 162, where it says basically businesses can deduct, quote, all of the ordinary and necessary expenses paid. So anything that is necessary and ordinary for your home-based business is going to be deductible. So now you can become a business and get yourself on the right side of the ledger where you're able to spend money and deduct that. And we're not asking you to spend more money. Rather, we're asking you to take your existing expenses and make them, to the extent allowed by law, deductible. Here's the problem with your paychecks, once again, is you're subjected to not only just one, two, but three types of income tax. What a home-based business will do for you is will give you the opportunity to attack all three types of income tax. First of all, you'll be able to attack Social Security, Medicare, Medicaid tax. The reason for that is because, like I said earlier, FICA tax, that Social Security, Medicare tax, that is based on earned income, your first $100,000. And so with a home-based business, you can actually generate unearned income and get from your business dividend income. You can, we'll get into this later, but there are several different ways to attack Social Security, Medicare, Medicaid income. Not only that, but you can also reduce state income tax by incorporating your business and setting it up structurally sound in a tax-free state such as Nevada, Wyoming, South Dakota, Florida, Washington, etc. And then lastly, of course, we want to attack the federal income tax, and we do that once again by reducing your overall taxable income. Once again, we're not asking you to reduce your income, but we're going to reduce taxable income. The way we do that, once again, is that we take advantage of the home-based business and we deduct all ordinary and necessary expenses, as opposed to you as an individual that can only deduct a couple of items such as your mortgage interest, charitable contributions, your standard deduction, and that kind of thing. And so here we are back with the two tax systems. Let's compare them with an individual. Let's use an example. Let's say an individual makes $100,000 of gross income. Then, of course, before they pay taxes on that, the IRS allows them to take their standard deduction and deduct it. The IRS also allows us to deduct any charitable contributions within certain limits, as well as interests on our mortgage. There's a couple others, but just to keep it simple, let's say that you're making $100,000, and after deductions, because you're only allowed a couple, you're netting $10,000 of taxable income. Compare that to a corporation. Let's say your business grosses $100,000. But now, instead of being able to deduct just a couple of items, now you can deduct office supplies, cleaning supplies, computer, telephone, internet, cable, automobile expenses, business, entertainment, business travel, home office deduction. Your retirement account is no longer limited to a $5,000 deduction with an IRA, but you can now set up a 401k and deduct over $40,000 per person per year. You can also employ your children. All of these deductions will be covered in our training modules. You'll know exactly how to deduct these, how much you can deduct, how you set up your books to do that. But if you've got all of these deductions, literally over 200 business deductions, and I've just named some of the more common ones. But if you can deduct all of these things, then you can easily see how you don't need to necessarily spend more money, but take the money that you're already spending and figure out how much is being used for the business. And then the business, even though it's making $100,000, after all of these deductions, it may only net $50,000 of taxable income. And the beautiful thing about that is that, as many of you are already aware, after you figure out what your net taxable income is, you go to the federal tax brackets and you figure out what percentage of tax you will pay. So it's not just a matter of deducting as much as possible for your expenses and get your overall net taxable income down, but the lower you can get that taxable income, the lower the percentage of your tax. And so it's really a compounding effect. But you'll notice over here on the right, a corporation can literally make $50,000 and still be in the lowest 15% tax bracket, whereas the individual that is making $90,000 would pay 28% if he were or she were single, and would pay 25% if that individual making $90,000 was married. So we're going to not only reduce the tax, but also take advantage of these corporate tax brackets that have always been lower. They do eventually catch up to individuals. Some of you that may be astute enough to say, well, if a corporation can make $50,000 and pay 15% tax, why don't I just set up 10 corporations, each making $50,000, each paying 15%? Well, the IRS caught on to that many, many years ago and set up a rule called control groups that does not allow you to just incorporate over and over again and split up the income amongst different corporations. But we don't need to use those kind of shenanigans when there's so many other tax strategies available to us.